Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm here to help you maximize your cash flow. Today I'm going over an infinite banking policy. Specifically, we're going to go over 6 different illustration options for a client, and I'm going to quickly go over with you the spreadsheets that I've made outlining those illustrations. I often move these illustrations into a spreadsheet because they're a lot easier to digest when you can see them right next to each other, rather than having to flip back and forth between 6 different illustrations, trying to find out what pages you need to be looking at and comparing this to that. Nobody wants to print out 40 of these things in order to just lay a few pages side by side. So this, I found, is a pretty good method of getting the information across to my clients. So let's go over what we see here.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
First, we're looking at a 40-year-old male. Now he's either going to be approved at non-tobacco rates or preferred non-tobacco rates. I'm not sure which one yet. We'll wait and see when that comes back. And it does make a difference in what we can qualify for. So he expressed to me an interest in having a $1,500 base premium and a max $15,000 out of pocket to start these policies. We're looking at Guardian insurance for the flexibility that it provides and being able to put in paid up additions, unscheduled paid up additions throughout the year at any point. You're not locked in on any particular schedule, so it makes it one of the best options out there as far as flexibility goes. So because of that, with Guardian, there's a minimum insurance amount that needs to be whole life. Now we blend whole life and term insurance in order to optimally design these infinite banking policies. So with a preferred non-tobacco rating at his age and gender, the minimum base premium is actually going to be $1,850. So we can't get it down to the $1,500 that he requested. However, if it comes back with an offer of a non-tobacco health rating, we can get the $1,500 because that gives you enough life insurance at that cost. What happens is that non-tobacco rating qualifies for a lower death benefit for the same amount of base premium. So we end up being able to lower the base premium down to $1,500, which is what he requested, and having that max $15,000. So we have our policy options. I have policy option 1, which is a base premium of $1,500, putting in $15,000 a year. Policy option 1 with a reduced paid up option. This is the same as policy option 1, except we turned off the premiums that were due in year 8. And we're going to do the same thing going in here, policy option 2 and policy option 3. So policy option 2 is if he gets the preferred non-tobacco rate, which is kind of where I expect him to be at, the base premium is going to be $1,850. So I designed this one with that max $15,000 out of pocket, which was what he had requested to begin with. And then we did a reduced paid up option on that. And then I added a third illustration for him, because if we have an $1,850 base premium, then I think it's good to look at putting in a full 10 times that amount in paid up additions, because you can. So if he gets a preferred non-tobacco health rating and he decides, yeah, I would like to actually put in the full 18 instead of just 15, he's going to be able to see what that'll look like with this illustration. And then of course we did a policy 3 reduced paid up option. So jumping back over here, I went down, I plugged it in. This is an L95 policy, so premiums get paid up to age 95. So you're going to see this spreadsheet go to 95. Policy option 1, we've got $1,500 base premium. That base premium gets paid every single year because we never turn it off. We don't turn it into a reduced paid up policy. And you can see our next column. Let me go over these columns real quick. So we've got our base premium column, which shows the base premium that's due each year. Total premium, this is the amount that we expect to pay. And for the first 7 years, we're going to try and pay 10 times that amount of the base premium. And then after that, we're going to pay just a little bit more, however much the software tells us it will let us put in without actually becoming a modified endowment contract. Our third column is the net outlay. So this is the total we've put into the policy on any given year, plus all of the years prior. So 15,000, and then the second year will be a total of 30,000. And of course, because we never turn off the premium, it continues to go up all the way until age 95, when we can no longer put in any more premiums. And then fourth column, we've got cash value. This is the cash value that's available to the client to borrow against. And then column 5 is our death benefit. This is the death benefit that buys. In the beginning, we have a blend of whole life and term insurance, which is what allows us to generate this cash value in the very early years. And that death benefit, once that term insurance burns off, so once we keep paying enough paid up additions that term insurance goes away, typically in year 7 or 8, then we see that death benefit start to grow every time we continue to buy paid up additions. And that will continue to grow all the way until age 95. And actually, these policies go till age 120, but I don't illustrate that many on these spreadsheets. So that death benefit will continue to grow as long as money keeps getting put back into it. Looking here at policy option 1 with the reduced paid up, you can see premiums turn off here in year 8. So we pay through year 7, paid the max 15,000, and our net outlay stops in year 7 at 105. You can see when we turn it into a reduced paid up, our death benefit drops just a bit, and then it starts to grow. And it eventually surpasses where we started at, which was 460,000. It'll eventually pass that and end up, close to 600,000, 588,000. It's about 200,000 less than when we didn't turn it into a reduced paid up. But you can also see here, if we compare these options, let me see if I can freeze these two columns. Okay, we're going to freeze those columns. Now we can see what they are when I scroll down. Okay, so going down here, we can see the amount we've put in policy 1 was 213,000, and then with the reduced paid up option, we only put in 105,000. So even though we had an extra 200,000 in death benefit and about 200,000 in cash value, we had to put in an extra 100,000 to get there. What that demonstrates is everything we've put in after the term insurance burned off, after we were able to put in 10 times the PUAs, and we had to drop that down, it wasn't quite as efficient. So this is a good option for people to maximize their cash flow those first 7 years by paying in so much in paid up additions, and then turn off the premiums, and your policy is going to run as efficiently as possible. Now, why would we not want to reduce pay up? Well, if you want the flexibility of continuing to put in a small amount and keep that death benefit growing, you wouldn't want to turn it into a reduced paid up. Let's say you have a health issue that arises and you think, and you know that you're not going to survive for another 50 years. Maybe you want to keep paying those small amounts and maximize that death benefit because you're not going to be able to qualify to get any other insurance. And that's the last option. And if you can't qualify to get any other insurance, you're going to probably want to keep this policy open and put in as much as you can so that you can keep bumping up that death benefit for whoever your beneficiaries are. So looking over here at policy option 2, we've got $18.50 that we put in, maxed out at $15. You can see our net outlay ends up being almost the same as policy option 1. We're able to put in a little bit more in that base premium. But down here at the bottom, age 95, we're at $229,800 that we put in. Your cash value has grown to $865, and your death benefit $931,000. So a little better numbers. That's because we put in a little bit more money than we did in option 1. So an extra $16,000 that we've put in, and we end up with about $115,000 extra. So pretty good return for just bumping up a little bit more in base premium. Now, moving on to reduced paid up option. This is the same amount that we put in option 1 reduced paid up, because we cut off that policy. We turned off those premiums after year 7. And so you can see our cash value is $610,000. Compare that to policy 1 reduced paid up, where our cash value is $540,000. We got a little better growth. Death benefit increased, $665, $588. Now the reason for this is because we went from a non-tobacco health rating to a preferred non-tobacco health rating. So we end up, even though we put in the same amount of money, we end up with an increased cash value and increased death benefit because the insurance costs aren't as high for the preferred health rating. So in policy option 1, we had the non-tobacco rating. Our insurance costs are a bit higher. Okay, moving on to policy option 3. We've got $18,050 that we put in, 10 times the amount of the base premium. And we're looking at, actually not, 18,500 would be the 10 times the amount. Looks like I can squeeze in a little bit more into that one. Policy option 3 though, if we figure 18,000 instead of 15,000, now we're looking at a cash value at age 95 of $994,000. We put in $251,000. Death benefit, almost $1.1 million. Now policy option 3 reduced paid up, $739 and $806. So we've got $125,000 more in premium that we paid in policy option 3 compared to the reduced paid up option. And the difference is about $250,000 between the cash value in those two. And our death benefit, a little bit more, about $260,000 difference in death benefit. So you can see when we streamline it with that reduced paid up option, we get a little bit more optimization out of our cash flow. But it's not a bad option to keep paying those premiums. So these are decisions that get made while the policy is in force. You don't have to decide that you're going to turn this into a reduced paid up when you first sign up for this policy. That's a decision you make in year 7 or year 8 or 10 or 15 or 20. You can take it year by year and decide when you want to stop and turn off those premiums. And that's going to be determined by your personal situation. And we run in-force illustrations at that time to figure out what's going to work out best. Now, one thing I want to note, let's take a look at our break-even period. With option 1, policy option 1, this is a non-tobacco rating. When we see our net outlay is lower than our cash value, we pass the break even. In this case, it's right here in year 5. So we have a 5-year break even period. $75,000 is what we paid in. We now have a cash value of $76,000. You're going to see the same thing with the reduced paid up option, because the only thing that changes is after year 7. Now, policy option 2, we step up to the non-tobacco rating, but we didn't maximize what we could put in as far as the MEC limit. So we didn't put in 10 times the PUAs. So we're still looking at year 5. Right here, we're still looking at year 5 for a break-even period. Now let's go to policy option 3 and look at this. Because we maxed out our paid up additions, we actually broke even in year 4. 72,200 is what we paid in, and our cash value is just over 72,300. So the only other thing to note about these is that all of these illustrations, these are not the guaranteed illustrations. The guaranteed illustrations perform a lot less. They make a lot of assumptions from those guarantees, like you're never going to get a dividend from the company. You're just going to get the base 4% rate, and the cost of your term insurance is going to go up. There's a bunch of things that it takes into account because they make that guarantee. For our purposes, we know that based on 180-year history, dividends are going to be paid out. You're going to get higher than that 4% guarantee. So we go off of the illustration rate because it's the best information that we have at the time. And these illustrations anticipate that it's going to continue paying out whatever the dividend rate is this year. Now, we also know that's not likely to happen either. Dividend rates go up and they go down. What we think about for the future that it's going to do, who knows? But we have to guess somewhere. So we're just going to assume that for these purposes, it's going to stay the same as where it's at now. As your policy performs, we do what's called in-force illustrations, and we can see what it's actually done based on the dividends that happened in the past, and we can compare it to what we projected when we started the policy. And over the long run, what people can expect is over the course of 30 years or so, you're going to get a 4 to 6% growth in these policies after your insurance expenses. So that's the appeal of these. Of course, you get all the tax benefits with that, and you get to use this cash value while the policy is active. So that's it for this video. I hope you found value in it. If you did, hit the like button down below. And if you have any questions, put them in the comment section. I'm happy to answer them for you. If you want to see more videos on infinite banking, check them out right over here, and we'll see you next time.